The most popular personal finance video on the internet right now talks about saving $10,000. And here's what the creator got absolutely right. Reaching $10,000 is a psychological threshold. It changes everything about how you think and act. But here's what he missed completely. From a tax perspective, $10,000 is also a financial threshold, and the decisions you make at this moment could cost you $30,000 over 5 years, or save you $30,000 over 5 years. That is a $60,000 difference. Not because of investing, not because of side hustles, but because of one single tax decision almost nobody talks about. Look, I know tax time feels overwhelming. You are probably thinking, here we go again, more complicated rules, more forms, more confusion. And if you are self-employed or a content creator, it is even worse. You do not get a W-2. You do not get a human resources department doing your withholding. But here is what makes $10,000 different. This is the exact moment where tax strategy stops being theoretical and starts being practical. And the difference between getting this right and getting this wrong? It could literally change your financial trajectory for the next decade. Let me show you exactly what I mean. You are a freelancer or content creator. You have hit $10,000 in savings. Congratulations. But here is what happens. Your net business income for the year comes in at $50,000. Now you owe self-employment tax. That is 15.3% on 92.35% of your net profit. $50,000 times 92.35% equals $46,175. Times 15.3% equals $7,065. $7,065 just in self-employment tax. That is before federal income tax, before state income tax, before anything else. You are paying 37% of your income in taxes right there. But what if I told you there is a legal way to cut that in half? Here's the game changer: S-corporation election. And yes, I know what you are thinking. S-corp sounds complicated. It is not. Let me break down exactly how this works. You elect to be taxed as an S-corp. You are still operating as a business. Nothing changes about what you do, but here is what changes with the math. Instead of paying 15.3% self-employment tax on your entire $50,000 profit, you now split that $50,000 into two categories. Category 1, reasonable salary. The IRS requires you to pay yourself a reasonable wage. For $50,000 in net income, a reasonable salary is approximately $32,000. You pay yourself $32,000. That $32,000 is subject to self-employment tax. $32,000 times 15.3% equals $4,892 in self-employment tax. Category 2, distribution. The remaining income, $50,000 minus $32,000, equals $18,000. This $18,000 is not subject to self-employment tax. So your total self-employment tax drops from $7,065 to $4,892. That is $2,173 you do not have to pay. Now here's where it gets even better. You are probably thinking, but wait, does not S-corp cost money? Yes, it does. S-corp setup, typically $800 to $2,000, one-time cost. S-corp annual compliance, payroll processing costs around $1,200 to $2,400 per year. Additional tax prep, maybe $800 to $2,000 more per year. Total additional cost, $2,000 to $4,400 annually. But you are saving $2,173 in self-employment tax. So your break-even point, 4 to 8 months. You break even in 4 to 8 months. The rest of the year, pure savings. But wait, there is more. When you hit $10,000 in savings, you qualify for another massive tax advantage that most people never use. Solo 401k. Think of a Solo 401k as a retirement account designed specifically for self-employed people. Here is what it allows. For 2025, you can contribute up to $23,500 as an employee deferral. Plus, and this is key, you can contribute an additional 25% of your net self-employment income as an employer contribution. For that $50,000 net income, that is an additional $12,555. Total potential contribution to a Solo 401k, approximately $36,000. $36,000 contributed to a tax-deferred account. This $36,000 reduces your taxable income. At a 24% federal tax bracket, that is $8,640 in federal tax savings. Plus, it reduces your self-employment tax base. That is another $2,180 in self-employment tax savings. Total from Solo 401k, approximately $10,800 in annual tax savings. From one contribution, one time. Now, most people stop there. They do S-corp or Solo 401k and call it a day. Do not do that, because there is a third strategy sitting right there that almost nobody uses, the home office deduction. And for content creators, this is absolutely massive. Here's how it works. If you use a dedicated space in your home exclusively for your business, and I mean exclusively, not your bedroom that doubles as an office, you can deduct that space. The IRS gives you two methods. Method 1, simplified method, $5 per square foot, maximum 300 square feet, so maximum $1,500 deduction per year. Method 2, actual expenses. You calculate the percentage of your home used for business. Then you deduct that same percentage of your utilities, insurance, property tax, mortgage interest, maintenance, and depreciation. For a $3,000 monthly living space with 200 square feet dedicated office, that is 10% of your home, 10% of $12,000 annual utilities, plus 10% of your home insurance premium, plus 10% of property tax plus depreciation. That easily adds up to $2,000 to $5,000 annually. At that 24% federal bracket, that is $480 to $1,200 in federal tax savings, just from the space where you already work. Now, before you get too excited, let me tell you the mistakes I see people make with these strategies. Mistake number 1, taking the emergency fund and using it for aggressive tax strategies. Do not do this. Your $10,000 emergency fund serves one purpose: emergencies. If you deplete it on a Section 179 depreciation strategy or an aggressive home office deduction, and then your equipment breaks or you have a medical emergency, you are forced into credit card debt or loan sharks. Conservative approach, keep your emergency funds separate. Use only documented defensible deductions. Mistake number 2, missing quarterly estimated taxes. This one costs people thousands. Quarterly estimated taxes are due April 15, June 15, September 15, and January 15. If you miss them, 5% monthly penalty plus interest. Action, set aside 25 to 30% of your income quarterly. Separate account, automatic transfer, non-negotiable. Mistake number 3, claiming deductions you cannot document. The IRS does not accept "I think I spent that," receipts, photographs, mileage logs, bank statements. Document everything or deduct nothing. Now, if you are a content creator, YouTuber, or influencer specifically, there is another layer to this. When you hit $10,000 in revenue or savings, the IRS asks one critical question: is this a hobby or a business? And here is why it matters. If the IRS decides it is a hobby, all your income is taxable, but your losses only deductible against hobby income, not your other income. If it is a business, you get access to business deductions. The 3 of 5 year test is how the IRS determines this. If you are profitable in 3 of any 5 consecutive years, the IRS presumes you have a business. So when you hit $10,000 in savings, you are proving this is real. Document this: profit and loss records for 3 to 5 years, content creation logs, investment in growth equipment, education, promotion. Once you prove it is a business, your deductions include camera, lighting, microphone, computer, all depreciable using Section 179 expensing. Home studio deduction up to $5,000 annually if you use that space exclusively for filming. Software subscriptions, editing, design, scheduling, stock footage and music licenses, cloud storage. Travel for content flights, hotels, meals at 50% deductible. Contractor expenses, if you hire editors, pay them on Form 1099. For a content creator with $50,000 annual revenue, documenting all of these, that could add up to $15,000 to $25,000 in annual deductions. At that 24% bracket, that is $3,600 to $6,000 in federal tax savings every year. Okay, so here is exactly what you need to do right now. This week, calculate your exact emergency fund needs. Multiply your monthly expenses by 6. That is your target. If you have high interest debt above 8% APR, make a list. Calculate the annual interest cost. Decide, accelerated payoff or maintain. Next week, run the numbers for your business. Calculate your annual net income projection. Then run 2 scenarios: solo proprietor versus S-Corp versus solo 401k. The difference will surprise you. Third week, talk to a CPA or tax professional. Show them your numbers. Get their recommendation for your specific situation. This is not theoretical anymore. This is actionable. By the end of this month, you should have a clear tax strategy for 2026. By December 31st, you should have implemented at least one of these strategies. Why? Because January 1st, if you have not implemented S-Corp or Solo 401k or home office documentation, you have already lost that entire year of tax savings. 1 year wasted could equal $3,000 to $10,000 in unnecessary taxes. Let me recap what we covered. When you save $10,000, you hit a threshold where tax strategy becomes genuinely valuable. Number 1. S-Corp election can save you $2,000 to $5,000 annually in self-employment tax. Break even in 4 to 8 months. Number 2. Solo 401k contributions can save you $10,000 to $15,000 annually through reduced taxable income and self-employment taxes. Number 3. Home office deduction saves you $500 to $1,500 annually. Number 4. Content creator deductions, equipment, software, travel, contractor payments can exceed $30,000, saving $6,000 to $8,000 in taxes. Number 5. Proper quarterly tax withholding prevents penalties that could cost thousands. If you implement just 2 of these strategies, you could save $5,000 to $15,000 per year. Multiply that over 5 years, $50,000 to $75,000. That is not abstract tax strategy, that is tangible wealth building. Now here is exactly what you need to do right now. First, if this video is going to save you money, subscribe, hit that bell notification. I release new tax strategies and financial planning videos every single week. Do not miss the next one. Second, this is important, empathetic. Share this video with one freelancer, one content creator, or one self-employed person who needs to know about these strategies. If they are in a high-tax state or they are struggling with quarterly taxes, you just saved them potentially thousands of dollars. Third, comment below, which strategy are you implementing first? Are you running the S-Corp numbers? Are you opening a solo 401k before December? Or are you focused on the home office deduction? I read every comment and I love hearing your wins. Fourth, remember, these are not just numbers on a spreadsheet. These are real opportunities to keep more of your hard-earned money and build wealth faster. The $10,000 threshold is here right now for you. The decisions you make in the next 30 days will determine your tax liability for the next 3 to 5 years. Alright, this is not about being complicated, this is about being strategic. Thank you so much for watching. I will see you in the next video.